You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by our special guest today, Luke Hallard. Luke, firstly, thank you very much for coming on the show. And could you just talk to us a bit about how you first became interested in investing and briefly talk us through your investing career to date?
Hey, Sam, thanks for the invite on the show. And I've been a fan of The Investor Way for a couple of years now. And I think you've also been following one of my podcasts. So it's great to finally connect properly. I tell you, you've got a wealth of questions lined up for me here. So I don't know if you got me on Zoom, I've got my cup of coffee in one hand and I've got a beer in the other hand in case things get really deep. So where are we starting? My investing career and kind of how I got to where I am today. Right. So I've been an investor for, I would say, about 20 years. And I started out in 2003, probably like most folk do, using index trackers. But it took a couple of years, 2006, I think, about 3 years in, and I felt like I built up enough money in my ISA, in my using index trackers, I could start doing a bit of exciting growth investing. And that's really been the exclusive focus of my portfolio, really, for the last 15 years. And I think my portfolio has always been US equities. I just find it a much more exciting market. And I know we might talk about a couple of companies on today's podcast that, maybe are less familiar to some of your UK listeners, but, great to have a chance to dive into some of those. So mostly US equities. I also do a little bit of venture capital domestically. We've got some really good tax incentives, SEIS and EIS schemes. So I do a bit of that. And in terms of where I focus my investments, I guess technology and innovation. I'm kind of a sci-fi guy. I like to think about where the world's going. And I suppose right now, it rotates a little bit, but right now I've got a bias towards health tech and companies enabling the work from anywhere economy, something that came out of the coronavirus pandemic. And personally, I very much hope is here to stay.
So there's a couple of things you said there that are quite interesting. So when you say you got into growth in 2006, how did you actually end up doing that? Did you just pick companies you liked, or how did you make that transition?
Yeah, so I suppose I first became aware of investing, maybe as most folk did, through something called the Motley Fool, really fantastic service way back. And I think I read a really good book, a sort of guide to investing by David and Tom Gardner, and just got me interested in this whole field. And I subscribed to a couple of their services, and there was one company that really stood out for me. It was a med tech firm called Intuitive Surgical. They're basically a leader in the field of robotic surgery, and just seemed like a really sci-fi investment, really where I felt the future of medicine was. And so, like a bit of an idiot, I went pretty hard on that investment. So I divested maybe 20% out of my safe index investments, dumped 20% into Intuitive Surgical, and sat back and watched what it did. And I think it doubled or tripled within the first year or two. And I thought, crikey, this is insane. You're never going to see that kind of growth reliably, particularly if you pick, one growth investment in your portfolio. But I got lucky at the start, I think, and it just gave me a taste of what growth investing could do for me. And then I suppose I was doing a bit of revision on my own investing history and prep for our chat today. So looking back at my trades, it looks like I was buying regularly from around 2010, probably about one thing a month. And I think I was probably, plowing money into the ISA and then trying to pick out one stock a month, my favorite pick from Motley Fool, but trying to apply my own sort of intuition on where I felt the world was going and really the kind of capabilities and the things that the world of the future would need. That's really my kind of lean on investing, how I select my investments. And that was probably the start of my journey as a serious investor. And if I look at how my portfolio kind of evolved over the years, probably my real growth, I've had lots of investments. I think at one point I had up to maybe 60 things, 65 different stocks in my portfolio. It's kind of an insane number. And I think we'll probably chat later. I think my portfolio tends to expand and contract over time. And I've got maybe I've backed into a bit of a rationale as to how I do that. But probably the real growth engines in my portfolio were Netflix from 2007 through to about 2021. I finally got out of that when it became apparent that they were really facing stiff competition from Disney, but made something like a 210 times return on my Netflix investment. And then Shopify was really the engine room of my portfolio from 2016, well, through to recently. They've taken a bit of a battering in the last couple of months, but even actually with a huge downturn they've taken, I'm sitting on something like a 20x return. So yeah, so I think, to sort of zoom out a little bit, trying to drive my portfolio by finding those innovative companies that are really delivering the stuff the world needs, going quite broad and having a range of investments across lots of different sectors, but exclusively in young growth companies that are doing quite exciting stuff. And then letting my winners run. And, if you have lots of investments, that's kind of how you operate a growth portfolio. Invest fairly broadly and the winners will show themselves, and then, double down and reinvest in those.
I think a 210 bagger is probably the highest return we've had on the show. We had a guy called Flosser on about a year ago, and he was on an 80x with Tesla, and I think it then went up to about 120x. But yeah, 210x, that's quite impressive.
I think you guys took a look at Netflix in your episode just a few days ago, didn't you? So I suppose if I'd sat on that investment up until now, probably be materially lower, unfortunately. But it looks like I got out at just the right time.
Yeah, we've looked at it a couple of times, and we've always liked it, but it's really tough. I mean, I think when you sat on the massive gains, in a way, it's sort of easier to sit on it almost. But I mean, every time we've looked at it, because it was always so big, even when we started the show, I mean, it's always been at a PE of like 50, and it is a good business, but it's just, I find it difficult with those businesses, and like, I don't know, I'll take quite a simplistic view and say, well, with Netflix, like how many subscribers do I think they can have? And if they're at 200 million now, or whatever, I think it's about 200 million. I don't know, could they have a billion? Like they possibly could. And if they got to a billion, it's probably quite cheap where it is now. But then if you think the ceiling's 250 million and it's a PE of, it's really, once you're at those high levels, at that kind of valuation, at that size, I think it becomes quite difficult then. So that's the problem we've always had with it. Whereas, I mean, this time when we last looked at it, it was down to a PE of like 29, I think. So that was probably the most attractive it had been, but we still thought it was a bit too expensive.
Yeah, fair enough. Well, and if you do growth investing, often you're investing in companies that don't have earnings, or if they do have a PE, it's like an insane triple digit number. So I guess you have to look for other metrics you can kind of value, or, other criteria you look for in a company, often quite subjective things, perhaps, that aren't so much to do with the financials, but I'm sure we can get into that a bit later.
Yeah. So how did you actually decide when to sell Netflix? Because obviously with your 210, Netflix is like the classic stock where if you look at it, you'd have like, 50% decline here, 70% decline there, and you'd have that all the way through. So although there's like problems recently, there's probably been similar periods. So how did you decide to hold on in the past? And then why did that change? Because to sit all the way to 210x, you must have had a lot of problems that you thought, well, actually, I'm not too concerned about that.
Yeah, I always took the long view, and Reed Hastings was just an incredibly visionary guy that was clearly going to, well, he did change the world in terms of how we consume content and entertainment, and reinvented business models in that area. But I guess they were ahead of their time, but the space became commoditized, right? And there are some brilliant competing services out there, particularly in the US. That's kind of where I look in terms of my investments. And just as you say, right, it was seeming as though they were getting a little saturated in their core market. And probably the thing that pushed me over the edge, I was a Marvel investor way back, and then they got acquired by Disney. So I kind of hung on because Disney, a fantastic company as well. And I think I've added to Disney a couple of times along the journey. So I've always been pretty close to what the company's doing. And you've got this amazing network effect with a firm like Disney, where they've got theme parks and merchandise, and now they've got Disney Plus as well. They can almost run Disney Plus as a loss leader, right? They don't have to make a profit on it because it's helping generate revenues for all these other parts of the Disney empire. Like, how do Netflix compete with that until they've got like Netflix land? So yeah, it just seems like it's suddenly going to be a very, very tough business. That's probably the main thing that drove me out at that point last year.
Could you talk about how, the other thing I wanted to talk about was you mentioned that you've been doing EIS and SEIS. What's your experience of that been like? Because I only see it, so I work in tax advisory and compliance for my day job. So I see it a lot at work. And the impression I get is a lot of people, they will invest just for the tax incentives. And although the tax incentives are very good, it's very unusual that I actually come across someone that's made a decent gain in EIS or SEIS. So what's your experience with that? And are you doing anything differently? Because a lot of clients, they do just, I don't know, they'll just pick a few based on the name. They're not actually properly researching the companies. I'm assuming you are.
Yeah, to some extent, although it's not a huge part of my portfolio. Probably today, I mean, it's hard to measure the value of some of these things, but I would guess it's about 3 to 4% of the portfolio. But I mean, maybe because I know you guys are big sort of UK investors. I've got one UK investment, which is a company I found in the sort of fintech space. And I think we're really good at fintech over here in the UK, kind of lead the world in many ways. But I think outside of that narrow domain, if you find a really interesting company, like a sort of startup, I know, Boris, when he was mayor, was trying to get Silicon Roundabout, turn Old Street into Silicon Valley, trying to encourage tech firms to start up there. Well, if there's any tech firm worth its salt, if they've got a really good product that potentially could change the world, right, they get acquired by one of the US firms at a great valuation. So they do brilliantly. But I think what you find then is a lot of these really exciting tech investments, they just don't make it up the funnel in the UK. And so, having said that there is some quite exciting stuff at a sort of VC and a sort of private equity level in the UK. Actually, I've only had one tech investment, which has been a successful exit. I think we exited for about a 7 times return on a small company that was acquired by Snapchat a couple of years ago. So unfortunately, they did so well. They got acquired within the 3 years of the seed round when I invested. So we didn't actually
pay the tax anyway.
Yeah, exactly.
It's a nice problem to have on a 7-bagger, though, isn't it?
That's right. Yeah. 7-bagger in 2 years. You can't really complain. So kind of did well there. But actually, the rest of my EIS, SEIS investments have all been more in the retail space, and I've got probably 5 somewhat material investments. That one that exited at a 7x. A second one has exited, but they're kind of sat and parked on the money. It's one of the risks of investing in venture capital. As a minority shareholder, you don't have a lot of control. So at the moment, the firm's sort of sitting on that for reasons of its own. There's a good rationale, but I think us smaller investors would like to get our money out. Can't really force the issue on that one. We have to sort of sit back and wait. And then of the other 3, 2 are probably complete dead dogs. And one is, I think, a fabulous investment that's doing really well. I will give the company a plug. It's a lingerie firm, in fact, called Blue Bella, with a really fantastic leader, Emily Blendell. And they're just doing really well. And I suppose coming back to sort of how did I find these? I do try to do my DD, but mostly I found them. The one that exited was actually a sort of friends and family investment. I got brought in by a buddy who was a university friend of the founder. So I got very lucky there, to be honest. And then the others I found through some of these like Crowdcube and Seeders, their investing events. And I do try to go, pre-coronavirus, I used to go along to those things. And to be honest, the majority of my DD, because you've got limited information when you invest at those early rounds, was looking the founder in the eye and having a chat over a beer after the event for half an hour. And I think, if you think about all the different subjective things that inform the quality of an investment, particularly in those early stage growth companies, like the quality of leadership is one of the most critical success factors. So I think you can learn a lot by just sort of chatting to someone and getting a sense of how they think.
It's really interesting that, actually, because just like a lot of our clients that do the EIS and SEIS, they tend to just do it through an IFA. So they'll find an IFA that then goes out and finds the companies. And I think a lot of the time with it, you get a lot of people where the tax tail's wagging the investment dog. So they're doing it for the tax relief, and then they're doing it through the IFA, and they're maybe not getting presented with the best companies anyway. And it's all right because the tax write-offs are so generous that you can never lose too much. But yeah, it's unusual that we see one. I can't think of a client that's actually like consistently investing in EIS and SEIS successfully. I know it's hard to tell because if they stay private, we'd never see it because it's not sold. But we seem to have a lot of write-offs and not many success stories.
Yeah, Fair enough. Fair enough. Well, I think I've been a little bit lucky in that space, particularly with that one or two that exited. My batting average is probably pretty good there, but it is a difficult, highly volatile space. I don't necessarily recommend it, perhaps other than with a bit of fun money for your listeners. But if you're going to get serious in that space, then going to the events, chatting to the founder teams, trying to be in some of the conversations. If you're a smaller investor, you're never going to be able to swing a board seat. But the nice thing about some of these investor events is, they do give you a chance to chat to leadership, and that's kind of the driver of some of my investment decisions in the past.
Going back to your investment journey, how did you then end up doing firstly telescope investing and then joining the Seven investing team?
So I worked for HSBC for 25 years, so working in banking, and that gives you a big exposure to financial services. I wasn't a banker per se. I was a kind of change guy doing big, complex global change for the organization, kind of leading global change. And I had the opportunity to take a sabbatical in 2020. So I planned this fabulous year off where I was going to travel the world, go to a ski season in Lake Tahoe in California, then go to some volunteering in the Philippines, do all sorts of really fun activities for a year, and then come back refreshed. I got my ski season in, and then coronavirus arrived right at the end of that. So that rather put paid the rest of my year. So the bank did say, well, if you want to come back, cut things short. But I thought, oh, I've got this opportunity, I'm going to use it. And some idea I'd always had in the back of my mind was, investing has been good to myself and my close buddy, Albert. And, he achieved financial freedom a couple of years ago. He retired. And, I wasn't far off at that point, to be honest. So I managed to twist his arm, and we thought we'd get together and we'd launch a podcast together. So that was Telescope Investing. And a lot of fun, very similar to the Investor Way. We'd churn out weekly episodes and articles. And mostly it was a chance just to collaborate with a really close buddy. He lives in Hong Kong. I live in the UK. Chance to sort of, have a chat, have a beer once a week, and talk about the stuff that we love, thinking about, because we debated investments for many years on WhatsApp. Yeah. And then I think as a transition from telescope investing to Seven investing was quite an interesting one and really quite surprising. So some of your listeners might be familiar with the name Simon Erickson. He's the CEO and founder of Seven investing, and super smart guy. And he came out of the Motley Fool, and he thought he'd start his own investing service. And Albert and I had admired Seven investing for some time. And if I'm being really transparent, I'm not just saying this because I now work for the firm and I don't work for the Motley Fool, but as a Motley Fool subscriber for all those years, the service treated me really well. I got some great advice. But in the last couple of years, I felt it's getting a bit markety, spammy, and I was starting to lose a little bit of faith in some of their due diligence. And so Albert and I had been signed up to Seven investing for some time, and we felt we were really getting a lot of value from our subscriptions there. We saw on Twitter one day, Simon was offering to join smaller podcasts as a guest. So we had him on to the show, I think in August or September last year, and we just got on like a house on fire. We talked about disruptive innovation, which is a topic that he's a real, world leader on, a real expert. And it's a topic that's very close to our investing philosophies too. I'm not sure how much influence it had on it. I sent Simon a case of beer as a bit of a thank you after we had the episode. But then in December, he reached out and there was an opening on the team. One of their lead advisors had taken up a quite exciting new role. And I had the opportunity to join them and take that seventh lead advisor spot. And, a little sad to move on from telescope investing. And Albert and I decided, the right thing though was for me to push forward with that opportunity, and haven't looked back really. I've got the opportunity to collaborate with, what I think is one of the smartest investing teams in the world. I'm suddenly on the inside, and maybe if you don't mind, I'm going to give the service a bit of a plug, but more to explain what it's about and why I'm enjoying this opportunity so much.
Yeah, go for it.
Yeah, so Seven investing, 7 lead advisors, and every month subscribers get a really detailed, 2,000 word investment recommendation. So we recommend a stock each. So you get 7 investing recommendations a month. But the really exciting bit for me actually is there's also a 30-minute deep dive. I actually recorded my deep dive yesterday for my 1st of May recommendation. So you have to do a proper presentation, pitch your investment to the team, and you get a bit of a grilling, you get proper Q&A. And that's a fantastic opportunity, to be honest, because suddenly, whereas prior to telescope investing, I think my investing decisions have been probably more gut feel and, hope perhaps rather than strict due diligence. Going from that to telescope investing, suddenly I had to be much more objective with my DD and at least be able to explain, why I felt a company was a good investment on a 30-minute heavily edited podcast episode. Or suddenly going from that to having to do a live 30-minute presentation, quite formal presentation with a lot of depth and a 2,000-word report to really back up my thesis. That's really, really taken my DD to the next level. So, I do get paid a small salary for working for Seven Investing, but the thing I really get out of it is collaborating with this team and being forced to do a damn good job in my own work. And to be honest, if I was being completely sort of mercenary about it, the DD I'm doing now is going to pay me in spades because I'm investing heavily in my own recommendations, and I feel like I'm really understanding them much more clearly than I ever did before.
Yeah, I found that when me and John started doing the podcast, like some of the earlier episodes. I mean, fortunately, I probably don't get the same level of grilling from John, luckily. And he doesn't make me do 2,000-word reports either. But just sometimes, I think, I remember some of the earlier episodes, and you'd say something, and then I'd say it to John, because what happened was I was having these conversations with John, and it was similar to you and Albert. I thought, well, we may as well just start recording them. And you say something on the podcast, and then you think, well, hang on, I'm not 100% sure if that's true, actually. But if I'd said it to John in conversation, I would have never batted an eyelid. And then it does. I think when what you're saying is actually going out to people, it does make you a lot more conscious that it has to be right.
Yeah. And if it's not, I don't know about you guys, but we used to get a ton of email telling us when we said something that was wrong. So that was quite a fun part of the experience too, having to, field those questions. And, in some ways you're also a little bit accountable, although, none of us are giving investment advice, right? We're not regulated in that way, but you do feel a bit of, your integrity's on the line, that you want to do a good job.
Yeah, well, yeah, our listener base, they're quite good at picking up on stuff like that. It's surprising as well, because I've had a few, because quite a lot of the interviews we do will just be like normal listeners. And some of the people that we've had on, they're just normal people, but they come on and they just the depth of their knowledge is just unbelievable. And you just sat there, or I'm just sat there thinking, like, what the hell are you listening to me for once a week? it is really surprising just how knowledgeable some of the listener base is actually. Could you talk about your compound annual growth rate and why you think you've been able to achieve it? Because it's a ridiculously high number, and it's a ridiculously high number over a very long time frame as well.
It's less ridiculously high in the last 6 months, I will say.
I think it's probably still ridiculously high.
This is probably where I should open the beer. I'll save it. So I think I'm doing pretty well. And, this is unaudited. And if someone were to pay for it, I'd certainly submit them for audit. I'm pretty sure my calculations are correct. But you're probably referring to I think at one point last year, I was claiming a 28% CAGR over about 17 or 18 years. And that's down to, so I did recalculate it over the weekend. So my portfolio has taken absolute battering in the last 6 months, along with, anybody who's invested in growth stocks. So my CAGR's down to 22.4% over 18 and a half years. So yeah, that's right. Still feel pretty good.
We'll do a whip round at the end. We'll set up a little GoFundMe.
Yeah. I mean, it's a little bit painful because if I think about the trajectory of my own life decisions, right? So I kind of quit. I retired from HSBC, and I wasn't earning 7-figure bonuses, but I was doing okay working for a bank. I retired, and then immediately my portfolio starts on this massive downward trajectory. So I was reflecting on this today, actually. In some ways, well, I mean, for one, I'm really glad that I have made this change in my life and I've retired. I think if I were just looking at the pure numbers and the sort of risk and the affordability, then I probably wouldn't retire based on where my portfolio is right now. But I'm glad I did, because that's given me the opportunity, to join Seven Investing, which I think is an investment in my own future in terms of that DD, but also just to enjoy the flexibility of working for a US startup. And I think you and we were going to connect last month, but I managed to do a month of skiing in the French Alps, and I'm planning to head out to Spain for a couple of weeks next week. I can do this job from anywhere. So these are opportunities I wouldn't have had if I hadn't have, or if I'd sort of stayed in a more traditional career in banking. So yeah, coming back to the CAGR though, I suppose, I mean, how did I get there? Let's talk a little bit about, I suppose, my portfolio strategy. And in some respects, it's intentional, and in some respects, it's something I've kind of backed into and then kind of understood what I've been doing in retrospect. And now it's become a bit more of my own personal process. So today I probably own around 30 different companies, something like that. But if we go back to that point where I had kind of 60, 65 different stocks, so that was probably, I don't know, 2012, 2013. And I was just investing, somewhat scattergun in stuff I liked and driven by, that view of the future. Or it's always been, this sort of look towards innovation and what does the world need, but kind of, scattergun investing. And then I thought, well, actually, I did a bit of analysis on my portfolio with Albert, and I realized the stuff I was investing larger amounts in on any given month tended to be outperforming the stuff I was investing smaller amounts in. So I kind of came to the realization that actually maybe I was making good decisions. I don't know if that was, luck. I'm like this lucky long tail, or actually, I had a bit of a skill for this. So I thought, okay, I'm going to have the courage of my convictions. And so I went through a period of contraction, and I deliberately got my portfolio down to, my objective was to get down to sort of 90% of my invested assets in a top 10 of stocks. Because I got down to that, and I had sort of the bulk of investments in about 10 things, and I had maybe a handful of others. And then a few years rolled on, and I kind of went back into a period of expansion again. And so I'm actually doing this right now. So I'm in a kind of expansion phase where if I think about what's happened most recently, and again, it's easy to look at this and say a lot of luck involved as opposed to judgment. And I'm certainly not trying to pretend that I can time the market. I got a little bit lucky, I think, with the timing of my own retirement. So this most recent cycle, just to kind of explain my rationale and my thinking, because it's quite fresh in the mind. I was retiring. I had something like a maybe 4 or 5% cash allocation in my portfolio. And I thought, I need to probably be a bit prudent and start to build up a bit of an income portfolio, even though that stuff makes me yawn, but it's kind of the sensible thing to do. And I should probably build up the cash position a little bit more, just to give me a buffer in case sort of unexpected things come up in the first year of retirement, not having an income. So I pushed that cash position up from about 3 or 4% to, I think, 21%. And again, this was probably, luck more than anything else. That was probably 3 weeks before growth stocks started to take a massive downturn. So that sort of 21% cash position kind of grew. I'm doing air quotes here. It grew because everything else shrunk, but it grew to about 30%. And so I'd done that contraction for probably the third time. Suddenly I'm sitting on 30% cash, and now I'm back in an expansion phase. So I've come up with a plan where I'm dollar cost averaging my way back into the market. So I think I'll never want to get below about 5% cash allocation again. And we can talk in a bit more detail about why that is, but I think it gives you a lot of utility in your portfolio. So I'm planning to, or I am in the process of reinvesting about 2% of my assets every month in a little bit of a mix of things, usually 1% in 2 different things every month. Sometimes it's something I already have, or sometimes it's something brand new, typically something from the 7 investing scorecard. And I'm expanding again. So I'm up to about 30, 35 different stocks. And I think what I'm expecting to happen, or hoping is going to happen based on the last 2 times I've gone through this cycle, is as growth stocks start to come back, I've got this broad range of investments. I can't predict the future, but I know I've got some good quality companies in there. And I think time is going to show me which ones are the real gems, which are the Netflixes and the Shopifys of the future, and which are the dogs. And, the best companies in that broad range of 30 or 40 things are going to show themselves. And then I can start to concentrate my assets back into those by selling out the things that are underperforming and backing the winners. And that's really kind of how I've run my portfolio, I guess, over the last 20 years.
You mentioned that you're wanting to build a bit more of an income. Are you talking about just starting to invest more in dividend stocks?
Well, I haven't done that yet. So, so the other effect, I suppose, so yes, that was my intention to build up a bit of a sub portfolio, probably no more than 10 or 12% that would be income generating. And so I'd started to look for those stocks, but then the market took a complete nosedive. And actually, it's probably the wrong time to invest in value investments when everybody else is, which is kind of right now. So actually, I've been forced by market conditions to flip back to my original strategy of investing in innovative growth companies. And I think as we will see this market turn, and there'll be a reversion to kind of risk on again, where investors as a herd, I use that word a little bit deliberately, start to favor growth stocks and valuations come back. And I think at that point, it's probably the right time to start building a small value portfolio. And if you guys have got some recommendations on good income generating stocks, I'm all ears.
Well, that's what I was actually going to say, because I don't know, if you're looking at US quote value stocks or like dividend paying stocks, a lot of them are still quite expensive. So like the yields you get on the S&P 500, and there's some very, very good companies, but if you're talking about like, I don't know, like your Coca-Colas or your McCormick's or stuff like that, they're fantastic companies, but I just wouldn't, I don't know what, I think I saw something earlier today that Coke's at like 28 times earnings or something, not 30 or something silly, which for a company that's growing like 6% a year is very, very expensive. There's a lot of UK equivalents where like we've talked about it on the show before. They're a lot cheaper and the yields are a lot higher, and they're probably not as good, but they are very, very good companies. But like, I mean, I think Unilever, that's got about a 4% yield at the minute. But Unilever's got its own set of problems. It's by no means a perfect company. Neither me nor John think it's particularly well managed at the minute, but the dividend yield's probably pretty safe. Diageo, that's like, I think that's about 2.5%, 3%, depending on where the share price is now. But that's another one where it's a massive, massive company for the FTSE. It's a really well-run business. It's got some fantastic brands. And then we had a guy on, I can't remember, I think we had a guy called James on the show. I think his username at the time was 20s Trader, but he's Quality Compound now. And he was saying Diageo at the minute for the global, like, I think it's like alcoholic drinks market or alcoholic beverages, it's got about 4% and it wants to get that up to 6%. And if you look at the share price and if they get to 6% with the brands they've got, which they probably could do, it's quite cheap. It's a very, very high quality business, but there's quite a few companies like this. And some of them as well, what I think is interesting with the UK is some of them are still a little bit more growthy. You just don't have the same multiples. So like one that we've banged on about every other week for about a year now is a company called Airtel Africa. I don't know why it's listed in the UK, but it operates in like 13 African countries, and it's a telecoms provider, but it's also got the mobile money. So kind of a bit like Jamea's got the Jamea Pay, except the volume on Airtel Money just blows Jamea Pay out the water. I think it's got a transaction volume of about $50 billion a year or something. And this company listed in the UK about 4 years ago. So it was a spin-off from an Indian company called Bharti Airtel, I think. And it's gone up quite, I think it's maybe doubled since we first started looking at it, but it's still very, very cheap because the business has got a lot bigger. But it's trading at a PE ratio of about, I want to say 13, 14. They've just upped the dividends, so it's going to be at about 4%. And it's growing at 20% a year. And it's still got, and that's just the core telecoms business. It's still got this the Airtel Money side of the business, which is only making up something like this figure might be a year old, but it was only about 11% of revenues or something like that. And that again, if you look at how big that could be with like e-commerce in Africa and stuff, and it's trading at a PE of about 13 with a 4% yield. And I don't know, there's a few companies that were like that where you just look at it and you think, well, what would that be listed at in the US? And that's one of the things I talked about with John, because I just think, what did they actually list in the UK for? Because if they listed on the S&P, you'd be talking about price to sales. You wouldn't even be talking about price to earnings. And then there's other ones like, I think Hargreaves Lansdown, that's got quite a good dividend now. And Hargreaves Lansdown, you'll probably know, it's massive over here. It's got about a 40% market share. They've just started to move into the cash market. It's got a lot of competition and the fees are starting to get eroded by the likes of free trade, but it is the dominant business. And again, like that's at a very low valuation. I don't think the share price has budged in about 5 years, but the business has doubled. And I think the dividend yield is about 3% now. So there's quite a few companies like that where it's very, very good companies and they've got decent yields. Whereas I think in the US, you would struggle to find that sort of combination. So I think on the FTSE 350, there are some very, very good stocks that pay a very, very nice dividend. It's just you have to be willing to sift through a lot more rubbish to find them. Whereas on the S&P, it's just you are probably consistently sifting through quality company after quality company, and that's just reflecting the valuations as well.
Yeah, fair enough. And I suppose as a tax guy as well, I suppose that there are benefits if your dividend or your income investments are in the UK. I think even if you have is this right? If you have an investment in an ISA, you still pay tax on dividends if it's ISA protected.
Yeah, so if you've got a US stock within an ISA, a lot of the time the US for overseas investors, they automatically deduct a 15% withholding tax. And if you put that on your tax return, you can get it back. But if it's in an ISA, because it's going to be at the lower of the UK tax, it just never touches your tax return. So you just suffer that 15%, and then you'd never actually be able to recover it. Whereas with UK, so yeah, if theoretically, if you were maxing out your ISA every year and you were investing in UK stocks and US stocks paying dividends, you'd want the US dividend stocks outside the ISA if you're doing it for tax. The problem is if it grows more, you want the capital gain sheltered. So it's tricky because a lot of the UK stocks, they probably won't grow as much as the US ones. So are you better just suffering the tax? Do you look at UK listed stocks at all, or is your focus entirely on the US? I know you've got one in your portfolio. So like, how did that one come about, and are there any others that you've been looking at?
So I suppose I don't look at the UK for kind of all those reasons I mentioned before, because like for me, the sort of exciting tech stuff doesn't happen here. They get acquired before they get to that level. If I think about the one thing I did buy, and unfortunately I can't discuss what that stock is because it is one of my active 7 investing recommendations. It's in the fintech space though, and in 7 investing, so we're allowed to invest anywhere in the world. The only constraints on advisors, complete remit to go with anything we want, has to be at least $500 million market cap, has to be tradable on a US exchange, but most UK companies still have an ADR, and in good conscience has to be something that we would recommend holding for at least 3 years. I typically think sort of 5 to 10 years. I found what I felt was a really high quality UK fintech that really had, quite early in its journey, had global potential. So it kind of fit all of my criteria, and particularly had brilliant leadership, which is something I really prioritize in a good investment. And so, yeah, I feel like quite lucky finding that UK investment. It's now, I've got an initial position of that in my own portfolio, but something I'm looking to add to because, like all growth investments, it's also taken a bit of a battering in the recent downturn. So brilliant means it's on sale. I can buy another piece a little bit cheaper at some point soon. But that's my only UK investment. And I typically don't look outside of US markets. Well, actually, that's not quite true. So I've got, a fairly substantial investment in Shopify, a Canadian company. I've recently started building a small China portfolio just for a bit of geographic diversity. I'm certainly not averse to the UK. I just don't look domestically beyond some of those venture capital investments.
Are you allowed to say if it's listed? Where is it actually listed? I'm just wondering how you came across it if you're not looking in the UK.
It's listed. They have a ADR, so they're listed in the US markets.
But it is a UK listed stock.
Yes, primarily listed on the LSE. Yeah, and it's,
Right.
it's a company actually. So I will say, without saying who it is, so it is a company that I discovered because I had to open a business banking account to engage with 7 investing. And I found these guys because they seemed to be the best sort of fintech that fitted my needs. And I was so impressed with the service I was getting from them as a customer. I opened a retail account and I now do a lot of my international banking with them. And I was so impressed that they became my 7 investing recommendation for, I think, March.
Do you have any other companies like that in your portfolio then, where you've started almost like the sort of the scuttlebutt approach, where you started as a customer and then actually thought, well, actually, I want to have a look at that and see if it's listed?
Probably less like that, but definitely the other way round. So often I'll see a company like, let's say, Netflix, where I think it's exciting. I want to invest, but if I can, I will try and be a customer of the company. And there's nothing like using the services of a company to really understand it from a product perspective. And how do they treat their customers and what's customer services like? Maybe try and fire in a query, see how they deal with that. Try and explore the boundaries of the use cases and just see how robust their product or their services is. So yeah, I've been a Netflix subscriber for well over a decade because it helps you understand the service. And maybe, that sort of ongoing due diligence, probably in the back of my mind, I might have noted that I was probably watching Netflix a bit less frequently, and that probably contributed to my sell decision in October. Although, as I sort of say that, try and be a customer of the companies you invest in. I've got a fair number of investments in health tech, and obviously you probably don't want to be a customer of those companies if you can help it. But still, it's nice to know that there's some fantastic companies really trying to revolutionize healthcare. So, if I ever do need their services, I know a little bit about several of those.
So could you talk about what your investment appraisal process is and how you would approach looking at a new stock or investment? So how something firstly would get onto your watch list, and then once it's on the watch list, what you're actually doing before it gets to the point where it would be, for example, like potentially a 7 investing recommendation for you.
Yeah. So I suppose Albert and I refined this in our sort of philosophy for telescope investing, but it's something we'd always done just without putting words around it. And we always termed these sort of mega trends. So, what is it that we think society is going to need in 5 years, 10 years' time? And who are the small companies that are kind of leaning into that and starting to provide those services that are going to be needed at scale in the future? And I suppose another way to kind of frame that and give some examples would be, you could ask yourself big questions about the world and about society. So let's take a couple of examples. Like, I do veganuary every January, but I love a good barbecue, right? I've got my ceramic barbecue outside, and now summer's coming. It's going to get lots of use. But, question in 2050, are we all really going to be consuming animals and animal products? I think it could be a bit like seatbelts in cars, where, if you go back a couple of decades, people were sort of very vocal and anti seatbelt, but now it seems almost barbaric. It seems extremely unsafe to not wear a seatbelt. And I say
I
that as a
think lab
motorcyclist.
grown is where it's going to go.
Completely. Exactly right. Exactly right. And that's the trouble in this sector. I love this sector. I think it's fantastic. It's super ethical. It's going to help hunger problems across the planet. It's going to help healthcare. But at the moment, it's kind of a highly commoditized business. So we had an investment in Beyond Meat, but if you go into Tesco's, right, in the UK, there's like 1,000 different meat alternatives, and Beyond Meat's lost amongst them. And it's still not it's not the end game technology, right? It's a great tasting product, but it's like pea protein and various other sort of very clever things, but it's not really meat. It's never going to capture like the hardcore carnivores. This isn't going to change until, exactly as you say, we can actually start culturing, a real steak. And in fact, a better steak, because you could take, you could harvest genes from, the world's tastiest cow, and without murdering that cow, and then you could grow, meter cubes of perfect Wagyu beef, right? And we've almost got the technology now. There's many companies that are advancing this, but most of them are private investments, so you haven't got access to them as a retail investor. But I think this will be an incredibly exciting investment space in the next 5 or 6 years when some of these companies start to come to the public markets.
So then I'm just trying to think, how would you end up then picking? So I don't know. I know Beyond Meat and stuff's not the best example in that it's not a particularly good business, but
Yep.
just say hypothetically you had this sort of more general overview of the industry and you decide, well, actually Beyond Meat isn't a commodity and you do want to learn a bit more about it. What sort of things would you be looking at?
Yeah, absolutely. So I suppose probably 10 key factors to try and look at. So the first thing is, is it in a mega trend? Does it have these kind of tailwinds? It's got market forces working in its favor. Because if you pick like a growing sector that's quite early in its evolution, well, a rising tide lifts all boats. So they got that support, as opposed to being, maybe you're in Rick, to stick with our old example, you're cattle farming and your business is probably going to get regulated away over the next 30 years. I'm not being like some kind of crazy vegan here. I'm just kind of stating where I think the world's going to get to, at least in the Western world, over the next couple of decades. So tailwinds. And then like leadership. So does the company have a quality leader with a proven track record? Hopefully it's still founder led. It's got that founder mission. And you can look at things like insider ownership, are the founders or the board's incentives highly aligned with shareholders? I think we've seen some interesting narrative around the Twitter board just in the last week or two, how they don't seem to really have any kind of material stake in the company. So they're probably not making decisions that are in the interest of shareholders. And then you've got some nice, this is a fantastic time to be a growth investor because you've got this wealth of information. So, even like a simple website like Glassdoor or Comparably, you can suddenly see somewhat unfiltered information about what employees are saying about their leaders and saying about their culture and how the company's operating. You could never really get that information before. Really empowers you as an investor to understand the firm. So that's the sort of people aspect. And then, other criteria, is it operating in a large total addressable market? It can often, this kind of TAM can be a bit of a fluffy figure that is, it's just unrealistic. Companies will put, we have, $1 trillion TAM, and it's clearly just complete nonsense. But there will be like a serviceable, addressable market. With the company's current capabilities, it might have a 10% market share. So, you've got this opportunity to kind of 9x your revenues. And, if we think about financials, revenue growth is typically the most important factor in driving the long-term health of a company. So, you want the opportunity to continue to grow your revenues, not to be a Netflix where perhaps you're getting to that point of saturation. And then also look at things like low costs of production. Is it quite cheap for the company to scale? And so they can get these operating efficiencies more quickly. Do they have a strong moat? So they might have like maybe patents or technologies, or maybe the moat is just, it's like an incredibly expensive business for a competitor to enter. Might have huge capital costs. So that's potentially quite a strong moat if you're in there and you've maybe invented that industry. I think brand, I'm going to say brand, but actually I mean a bit more than just brand. But if the company has a strong recognizable brand, then I think that can be hugely beneficial, not just for sort of marketing and everything else, but, just sort of awareness of the company. But another aspect, I think, when I think about brand is kind of culture of innovation. And I suppose, I think we're going to talk about Tesla a bit later, but, the sort of innovator slash brand master of the universe, really, Elon Musk, right? If nothing else, right, paying almost $0 on marketing and attracting some of the smartest people in the world because it's just such an exciting mission and they're going to learn such a ton of stuff working for him is a significant advantage, right? It's just, you're sort of sucking up all of the talent from your competitors, particularly in some of these narrow industries where there aren't that many folk perhaps who really have the deep expertise. And then a few other kind of things I look for as well. So, strong network effects. We talked about Disney earlier and the network effect across the merchandising and the Disney Plus and the parks and everything else. That's really, really sort of helpful flywheel as they can cost effectively scale and one part of the business helps the other. What are their customers saying about them? There's a couple of nice websites that give you good insight on that. But, you could also look at financial metrics like dollar-based net retention, are customers spending more and more each year? And, do they not have too much customer concentration? Fantastic company like Marqeta, I'm quite a big fan of in the fintech space, but they're kind of beholden to Square a little bit. I think Square is, more than half of their customer base. So quite a dangerous risk exposure for a company like that. Maybe the company has great optionality. You don't want to see them doing things that are completely outside their wheelhouse, like, I don't know, stupid example, AMC getting into mining, whatever the hell that was all about. But, there are very sensible ways that smart companies and strong leaders can expand their addressable market by moving into adjacent industries and kind of expand organically. And then I think we've gone through kind of 9 things there. And I'd always thought about those. And that was kind of my focus during the days of telescope investing. I suppose more recently now, I'm looking much more diligently at financials. That's always been part of my framework, but I kind of waved my hand at it prior to joining Seven Investing. And now I look much more diligently because I'm going to get those tough questions in the deep dive around financial metrics. So we mentioned that, importance of revenue growth, particularly for a company that may not be profitable today. Dollar-based net retention, very important. You look for other, good metrics that are perhaps rapidly improving, things like rapidly dropping losses as a potential of revenue or increasing profits, improving margins, maybe better lower customer acquisition costs, improving cash flow. Yeah, so there's probably a bunch of things you can look at there. And I suppose I've seen other folk. Let's pick out a couple of names. Say Brian Feroldi and Brian Stoffel, super smart analysts. They've got their own frameworks, and they're very they try to be very objective, and they'll put a number on stuff and they'll add it up and they'll get a score and they'll say, okay, that makes it a good investment or a not so good investment. I think I try to be a bit more subjective with it because I think every company is unique. And I think there's perhaps more art than science to investing. So I think what I try to do is I look at all of these factors and the context of the company, and then I just try and weigh it up as a package. So these are kind of, angles to understand the company. And then I try and make an overall, somewhat subjective decision based on all of those data points.
Reminds me a bit of a Buffett quote. I think it's from one of the Berkshire meetings from like the 90s, but someone asks Munger, I think the question was directed at Munger. It's just a generic, like, how do I invest well sort of thing. I think either Munger or Buffett, but one of them said that like the best investments are obvious. I think when you look into the best companies, there's not going to be a perfect company, but you do. I don't know if you look at your biggest winners. I think a lot of the time, if you were to go back, and I know you've got the benefit of hindsight, but if you were to go back and look at them when you first, it just seems quite obvious, just because they've got so many more, I guess, green flags than red.
And I think that's interesting, isn't it? Because I think as you get a bit of experience, and as I say, I've been doing this for sort of 20 years, I think you can come to trust your gut quite a lot. And there's a company I've been looking at quite recently that on paper I was really keen on, but just my gut has held me back on it a little bit. And I won't say the name because it might be a Seven Investing recommendation in the future. But I think sort of trusting yourself, there can be sometimes a lot of value in that.
Yeah, well, we've had it on the show sometimes because we'll cover 5 or 6 a week. We might not look at something for a few months, and then you go back and you look at it, and it's like, well, why is it so cheap? And then like you'll look, we've had it, like, for example, the first time we looked at Airtel Africa, which me and John have both subsequently invested in, we never heard of it before we looked at it on the show. The first time we looked at it, we were just, because the valuation was so low compared to the growth rate, we were just saying to each other, like, I don't understand what's actually wrong with this, because there must be something, because it wouldn't be that cheap. And there are definitely risks associated with it, but to me that was one where it just seemed very obviously mispriced. And I think I think the more businesses you look at, almost the less of those you find, just because you sort of, I don't know, I guess your standards become higher and higher. And it's, there's probably, I'd say every 4 or 5 months, maybe me and John will cover something on the show, and it would just seem just so mispriced compared to everything else we've looked at in the last 3 months or so. And those are probably, like, I've sort of, it's not really a rule, but I've started adopting the strategy now that if me and John if we have a stock that comes on the show 2 or 3 times and we cover it and we both really, really like it, then that's usually my trigger now, where I say, well, actually, I need to have a proper look at this, because we've had it on, we've covered it 3 times over a year, and neither of us have found anything bad about it. How much does valuation factor in to what you're looking at then?
I mean, it does, but I think you can't let valuation dominate your investing decisions. And the greatest companies in the world will always feel expensive all the way along the journey, even from quite early. So probably I give more leeway on financials, and some, maybe it's just like, say, it's a blunt metric, but price to sales ratio. I'll give younger companies more leeway on that, and I'll be happy to invest in something that's got quite a punchy valuation perhaps, because they've got, they're so early in the journey, and you need to give them a chance to kind of prove themselves. And, as a company matures, maybe you should start putting a bit more focus on some of those, on valuation. And, certainly as a company transitions into, generating free cash flow and generating, real profits at the bottom line, then you can, it's becoming more mature at that point. And there's a whole bunch of valuation metrics you can look at, probably give you quite good insight on how well the company's being run. But yeah, I suppose typically, I haven't actually looked at the sort of average market cap of my portfolio, but instinctively, apart from, a couple of, like a bit of a Google and an Amazon and some real, like, mega caps like that, probably the mode of my, the market caps in my portfolio is probably in the sort of $5 to $10 billion range. So, smaller, punchier companies, and there it's a little bit harder to judge valuation, because there's so much that is, that you can't put into numbers. It's really, the culture and the leadership and the space it's operating in, things like that.
It reminds me a bit of the Brian Feroldi approach, where he'll talk about stuff and say, well, if you look at it by any valuation metric, it's expensive, but it's a $2 billion market cap, and I could see it being a $20 billion company. So when you think about it like that, it's still pretty cheap. What do you think about companies then? Have you noticed any difference now compared to when you first started in terms of the valuations? Because, like, for example, like the extreme end of the scale, like Airbnb came, listed as like a 70 or $100 billion company or whatever it was. And if that had listed at a $10 billion valuation a few years earlier, it would have been in that Brian Feroldi camp, where it's like, well, I could see it being a $100 billion business, so it doesn't matter if it's expensive. Whereas when it's already a $100 billion business, it's a lot harder to look at it and say, as wonderful as it is, could it be a $1 trillion business? It's much harder to say.
Yeah, but I think, taking that as an example, I do think it's a well-run, founder-led business with a very clear mission, and to me, does have strong tailwinds. And if we think about the way the world is probably changed as a result of COVID, I don't know if this will be proven to be true. I guess we have to, let the next year or two play out. But I think the world's best companies are going to retain some form of flexibility in their employee contracts. And actually, I've seen some statistics that say like a large proportion of employees would take, on average, a 37% pay cut, I think I read, to have the ability to work from home full time, or, or at least have that control of where and when they work. And I'm, anecdotal, but I'm really enjoying that way of working myself now. And the best companies, they can still succeed, they can still get the job done with a fully remote workforce, right? They were forced to do that during the pandemic. And in many cases, companies actually saw, real objective financial benefits. And if they, they've now got the opportunity to downsize their real estate, realize some operating efficiencies. So I think the best companies are going to persist with this kind of work from anywhere mentality. And so that very much plays into the hands of a company like Airbnb, where they are, they're not just offering like hotel rooms or service apartments. They're offering like a real home as a long-term stay. If you're staying somewhere for a month or 2 months, I rented a house in Lake Tahoe for 3 months. You don't want to be in like a hotel room for 3 months, or even like a little service apartment. You want like a proper kitchen, and you want a garden, and you want to feel like you're kind of embedded in the community a little bit. And that's a model. The Airbnb have competition in Vrbo, owned by Expedia Group, I think. But and Booking Holdings, they also, big competition. They have some of those independent style properties on their books, but Airbnb are certainly the leader in this space, and it's it's the whole rationale. It's what drives the mission. And so, yeah, it's what is it, like a $90-100 billion business today. I'm not sure it could be a $1 trillion business. Certainly not until we're perhaps a spacefaring civilization and we've got Airbnbs on the moon. But I certainly think it's a reasonable valuation today, given their potential.
So do you feel like your style of investing has not been made any harder then? You don't feel like there's less companies around than when you started? Because I know there's an element of hindsight bias with it, because you look and you say, well, look how cheap Netflix was 10 years ago, look how cheap, and you just pick the winners. But companies are coming to market later than they used to.
They are. That's true. That's interesting, isn't it? I certainly don't think there's any lack of investment opportunities. And I suppose if you spend enough time with the right FinTwit followers, you start seeing the same names over and over again, right? But there are some quite niche companies that not many folk are talking about, and perhaps in some of these narrower fields like health tech and med tech, where, there are some quite exciting, less well-known investments where the sort of Reddit Wall Street bets crowd haven't suddenly got behind them and driven their valuations to insane levels on the back of uh, you know ghosts and fluff. And then if we come back to talking about sort of cultured meat, there's a real sort of startup push at the moment. There's a whole bunch of really exciting companies that are yet to come to market. I think you're right. When they do come to market, they're probably coming in at a much punchier valuation. Seeing companies like Stripe and SpaceX, with insane valuations at a private level that we've never really seen before. But they're probably the exception. I think there's still going to be a ton of really good opportunities, in all of these sectors. And if we just look at, what's happening with innovation and the way the world's changing, things aren't slowing down, are they? The innovation is compounding, and there are so many dynamics that are just changing the world at a faster and faster pace. And so, if you were, say, I haven't got any good examples, but if you're like a railroad company or something, super stable, or perhaps you're in, mobile phones and mobile networks, and you've had this healthy business for decades, and then suddenly along come like the Googles, and they're starting to disintermediate you, and Facebook with WhatsApp, suddenly your SMS business is dead. Well, that's only going to happen faster and faster. So it's exciting as an investor to keep your eye to the horizon, but if you take your eye off the ball, then very quickly you could find yourself with a bunch of companies that really have legacy IP and legacy technology, and they've been overtaken, which is probably why I think growth investing certainly isn't for everybody. I would say 90% plus of investors should invest in index trackers, low cost passive index trackers, and let the market, just deliver compound interest reliably. And over the long term, you're going to make, a market equaling return by definition, and you're going to do just fine. I do think if you're going to put the time and the work in, you can find those really exciting opportunities. And, podcasts like your own and services like Seven Investing sometimes suggest really interesting ideas that you may not have thought of. So there's certainly a lot of value in getting out there and using Twitter to, chat with other really smart analysts about some of these firms. But you've got to do the work. And I think if you're not treating it as almost a passion and a hobby, then you're perhaps kind of hamstringing yourself in the long term, because those, as I was kind of saying, the companies that are fantastic today, even faster, are going to get overtaken in the future. So you've just got to keep abreast of where the world's going.
So what do you think? Because I think there's a Bill Gates quote from, like, I don't know if it's 10 or 20 years ago, where he says that actually, like, a lot of the tech businesses should actually trade at a discount to the normal valuations because they get overtaken so quickly and you just don't see it coming. And that's not the case. They definitely don't trade at a discount. So what do you feel? How do you feel about valuations in the US? And do you think there should be more of a discount, because they can, even the best companies today could just be completely disrupted in 10 years' time?
Probably not, but in the same way that I have, maybe 30 something things in my portfolio, I'm expecting, half of them to kind of go nowhere and to languish and to drop. And I'm expecting maybe one or two breakout winners out of that. But what's that Peter Lynch quote? If your batting average is like 6 out of 10, you're doing pretty well. So, you only, as you and your listeners, I'm sure, well know, you've got this asymmetry where you only really need, 1/200 bagger, and that's going to cover the losses of really a lifetime of poor investments. So if you can get a couple of those in your lifetime, then you're going to do pretty well. As to whether tech companies should have a sort of lower valuation because of that risk, I don't think to me, it's not how the world works. But it's down to an astute investor to try and find the best companies. That's not saying you need to magically, pick exactly which company is going to do well. But I think if you, as Albert and I kind of stumbled into, if you find a sector that's growing And, even if you only invest in the category leaders in that sector, you're probably going to make out all right.
I do actually agree with you. It's just what you said just reminded me of the quote. It's like, I think if you take Google and Facebook, for example, and compare that to the best companies, I think it's maybe more than 100 years ago, like 120 years ago. So if you compare Google and Facebook to Standard Oil and US Steel and Standard Oil could never dream of the growth rates that Google and Facebook still can, because they needed the capital. They needed to invest the capital. And I think with a lot of the tech businesses now, there's no doubt the businesses are just, we are probably living in a period of the best businesses we've ever seen in the history of capitalism. I don't think anything else really compares to it. So what are the best books that you've read on the subject of investing, and how much do you read in general?
I was going to try. I thought, should I make up an answer to this? But I'm going to be really honest. I really only read for pleasure, so I don't read investing books. I've got a rack of books behind me. Those are mostly poker books because that's also a passion. There's a couple of business books scattered in there. I think, I suppose I'm not gonna sort of badmouth any authors. When I read finance books, often it's like one or two good ideas that have been padded out to book length, and it could have been a blog. There's certainly some exceptions to that. I haven't read Feroldi's book. I gather it's good, and there are certainly some great quality books like Morgan Housel's Psychology of Money, which are packed with investing wisdom. But I would say most of my education comes from podcasts and Substacks. There are some really, really good, young, very, very smart analysts out there. And I'm happy to give a shout out to a couple of names, if you like, that are just laser focused on some of the industries I like to invest in. And they're turning out investing wisdom and brilliant quality due diligence every week. So to me, that's much more relevant than reading a book that's, is probably a little bit out of date the moment it hits the press.
Do you want to give a few names then for Substacks?
Yeah. So a couple of Substacks I do recommend. I actually interviewed a guy called Brad Freeman, stock market nerd, about.
Yeah, I follow him on Twitter. He's very good.
Yeah, he's great. I interviewed him for Seven Investing podcast last week on Match Group. Had a lot of fun actually. Good, like great guy, but actually, he really knows his stuff. He's got about 10 stocks that he follows quite closely, and he turns out like a really good newsletter every week. So highly recommended follow. There's a guy MT Capital who's also just turning out great quality material on a number of companies I'm interested in. There's a Spanish analyst called Invest Quotes, a guy called Leandro.
Yeah, we've had him on the show actually.
Oh, great! Wow, fantastic! I'd love to connect with him. I haven't spoken to him yet, but
no, he's very, very good. Yeah.
Yeah. And then if I go down, so those guys are kind of generalists. They've got a bunch of companies they're interested in. And if I go down to the sort of rabbit hole of some of the sectors that I focus on, so probably in the med tech, health tech space, a guy called Richard Chu, very smart guy who we interviewed for Telescope last year, and also Adu Subramanian, a young investor in the US. His parents work in healthcare, and he's studying as a med student, but he's an investor as well. So he's got some real good domain knowledge there on some quite interesting med tech investments. I do a bit of investing in ad tech. Most of my ad tech investments are in the hole, but I do believe it's a sector that's got significant tailwinds. There's a guy called Deval Kotecha who's got some interesting stuff to say about some of those companies. And then sort of software as a service, those enterprise software companies that I think just have fantastic business models. Probably required reading for those are a guy called Peter Offringer. So he writes under the brand of Software Stack Investing. And then also Muji at Hypergrowth with 2 H's. Although Muji's now kind of gone premium on his Substack. So there's a lot of really good quality stuff behind his paywall. And then I do still use the Motley Fool, some of the discussion boards. So I put less, if I'm honest, less value on their recommendations, but their discussion boards are great. And there's a particular discussion board that actually it's open to everybody that I would recommend called Saul's Board, Saul, S-A-U-L. And just some super smart guys in there chatting about a handful of software as a service companies that really are going to change the world, I think.
I think of all the names you mentioned, I think I followed all but one of them on Twitter. So what do you read then that's not investing, just out of interest?
I'm on book 5 of Game of Thrones right now. and like a ton of sci-fi. I suppose actually, in some ways, the sci-fi is kind of investing adjacent because, and I've always been a fan, bit of a geek, fan of the world of the future, and so there are some very interesting thinkers who put out their ideas in the form of fiction, but they do they open your mind up to the possibilities, good or bad, of the future. And so in some ways you could say that that's helping the kind of big picture due diligence, perhaps.
Have you read 20,000 Leagues Under the Sea?
It's a classic. Not for years. Jules Verne, right?
Yeah, I just always mention that one whenever anyone says sci-fi. I find it so interesting, just because without spoiling it for anyone that's not read it, just like the thing that he came up with just isn't that advanced now. But obviously, 100 years ago it was.
Yeah.
I think
another example, like Arthur C. Clarke, right? I think I don't know if it's true or not, but he sort of invented the concept of a geostationary satellite.
I'm not familiar with that.
I might have made that up, but I certainly, I certainly think there are, interesting thinkers. Well, let's take a real example, right? William Gibson and Neil Stephenson, right? Their books, Neuromancer and Snow Crash, arguably they invented, inverted commas, virtual reality and the metaverse. And I think I've got my Oculus Rift sat next to me on the desk here, right? I think we're quite early in that story, and I don't know if it's an optimistic or pessimistic vision of the future, but that could be the future of how we communicate, do business, socialize, right?
Have you read Ready Player One?
Yeah, Ernest Cline. Yeah, loved it. Ready Player Two was garbage, unfortunately.
I actually haven't read the sequel. I was probably wrong. I've not. I saw a few people on Twitter saying it wasn't very good either, which is a shame because I loved Ready Player One. I loved the film as well. Actually, I thought the film was fantastic.
Yeah, different, good but different. I'll give you a different recommendation then. All You Need Is Kill, and the movie became that Tom Cruise movie where like he keeps going back in time and he keeps reliving his death.
Is it Edge of Tomorrow or something like that?
Yes, that's Edge of Tomorrow. Yeah. So I thought the film was great. The book is better, but they're both completely different. But they're kind of the same thing.
I like the film. I thought the film was good. Anyway,
the book is fantastic. Back
to the podcast.
Yeah.
You've already touched on quite a lot of these, but what resources would you recommend for investing? And these can be free or paid, and you can plug your own again if you want.
So clearly, Seven Investing. I will say, actually, I was going to save it at the end, but here's an opportune moment. So I twisted our marketing team's arm, and they've offered an introductory rate to the Investor Way listeners. So if you sign up over the next month or so at 7investing.com, and if you use the promo code 7stocks, so number 7 STOCKS, then you can get in at half price. So for our normal rate is $49 a month. So for $24.50, you'll get access. Even if you only sign up for a month, go watch all my deep dives, read it all, and then cancel your subscription. You'll get a ton of value out of it. So I do recommend that. And, hopefully you enjoy the service and stick around. But beyond Seven Investing, all of those Substacks, I do use the Motley Fool, but as I say, I think I've sort of outgrown that a little bit. Plus the marketing kind of has worn me down, if I'm honest. The constant email barrage. I might plug a couple of Twitter accounts, if that's all right, that I follow. And I was thinking about this through the perspective of, chatting to a UK podcast. So if I'm going to big up a couple of like smart British folk that I follow on Twitter, I think Adventures in FI and Monovator, those guys are great follows on Twitter. They're more in the sort of, managing your finances perspective. And then two names that I think are actually quite interesting thinkers. A bit of a wild card, a girl called Liv Boeree, Boeree. She's a British poker player, bit of a science nerd, but actually, a very, I think, an interesting thinker and expresses herself really well. And a chap that I'm sure many of your audience would have heard of, Benedict Evans. Seems to be a super smart, bit of a philosopher, kind of an ad tech guy, but he does seem to ask quite tough questions, and he's pretty sort of pithy and funny with it. So he's a good follow, and he's got quite an interesting newsletter you can read.
Who do you look up to as an investor?
My buddy Albert, if I'm honest. I think he's very smart. He's very funny, and he hasn't calculated his CAGR. He refuses to, but I'm pretty sure he's beating my own. But also the Seven Investing team. I think there's a couple of guys and girls on the team who are, really are world class. And then, I think there's this cohort of young analysts, and we've shared a couple of the names already, who I think are, not just extremely smart investors, but they've got some really interesting domain knowledge. And I think that's quite an interesting convergence when you bring, your passion for a particular field together with a bit of investing know-how. That can be quite a powerful combination.
What do you know now that you wish you'd known when you started investing, and what advice would you give yourself when you were just starting out, if you could?
It's probably time to open the beer now. What do I know now? I think have the courage of your convictions and kind of trust your gut a little bit more. And I suppose here's one thing I probably still haven't got right, but I'm trying to improve. Like, I just have this woeful process for selling. I think I've got this sort of sticky mode where, I hold something, and I just kind of at some point the thesis has played out, it's a disaster, but I'm still hanging around just in case. And even, often I'll justify that to Albert, because I do try and rationalize all my investment decisions with him. I'll rationalize it as, oh, it's so far down, it's not even worth selling. It's, such a small investment. But I think selling, well, every day where you don't sell, right, that you've taken a decision to continue to hold that stock. So I think, I need to use my gut more and just be a bit more ruthless in cutting loose, cutting bait with the stocks that aren't really playing out.
I think if you'd had that ruthless approach, you would have sold Netflix before it got to 210 back then. Because there would have been periods where it's down 70, 80% for you.
Yeah, interesting. Maybe, I don't know. I mean, I'm certainly, well, okay, so that's interesting, right? So the current valuation, I put very little stock in. That people say it, you can say it, but then you can really believe it, which is, watch the company, don't watch the stock. So, valuations are driven by so many different things, from, the fundamentals of the company, which are incredibly important, to what an analyst had for breakfast that day and what the weather's like and how his relationship is with his partner, and macro forces that are nothing to do with companies, like global pandemics and wars in, unfortunately, in parts of the world. So, all of those things can dictate the stock price on any given day, or, any given year to year. But I think if you watch the fundamentals, that's really, that's really telling you where the company is going to end up. So if companies I truly believe in are massively in the hole, as most of my portfolio is right now, at least over the last 6 months, I genuinely see that as a positive thing, because currently I'm kind of long cash and I'm putting it back into play. So this is going to reward me in the long term.
How have you evolved as an investor?
Yeah, I suppose I went from that gut feel and really kind of story based and investing on very little due diligence. That intuitive surgical investment was literally based on, oh, this seems really smart. This is a kind of science fiction thing. When I get to 60, if I need some sort of operation, I want a robot to do it, because it's going to be much more reliable than a flawed human who might have a hangover. And so that gut feel across my portfolio to being more diligent. And I suppose, as I said earlier, that joining Seven Investing is forcing me to be much more focused on financials. So that's probably the nature of my evolution. And then, where I need to get to next is just being a bit more ruthless and, cutting bait with the stuff that really doesn't belong in my portfolio. There's a couple of those where I've been quite public. Well, I'll say one, because it's not a Seven Investing recommendation for me. Magnite has been part of my portfolio, ad tech name. I've been a supporter of the company for some time. I'm starting to really doubt myself on that one. So I'm going to refresh my due diligence over the next couple of weeks. And, maybe that's something I need to exit from my portfolio.
What are the biggest mistakes that you've made in investing?
Well, so, okay, an easy one that I'm sure everybody would say is not investing enough in the early days. And really, what drives your investment returns at the start of your investing journey is the money you're putting in, not your CAGR or, your growth rates. At later, it's much more driven by, what's in your portfolio as opposed to how much money you're putting in. Actually now now I don't have an income anymore. So I'm in a mode of probably sort of not putting new money in right now. And at some point I'll have sort of spent the money in my current account and then I'll be a net withdrawer from the portfolio. But I'm expecting to continue to grow my portfolio at a faster rate than I'm withdrawing from it. That's the kind of, my life thesis. But I certainly should have started sooner. I guess I started in my, I don't know, my early 30s, well, in my late 20s, I guess. And also, I suppose, I was a bit of an idiot. And about maybe 6 years in, got a bit cocky about how my investments were performing. And I became a net withdrawer for a couple of years. I went on a quite expensive vacation to Japan, bought a new motorbike, and I was using the ISA to fund those. So, in retrospect, that motorbike I spent, whatever it was, like £5,000 on, probably ended up costing me a hell of a lot more. If I'd left that money in the ISA, it would have grown along with the CAGR, sort of withdrawing too soon. And then maybe a real life lesson, I suppose, that might be a bit less common. It was a property transaction I did a couple of years ago, well, quite a few years ago, the sort of, youthful optimism. So I got drawn into buying a couple of properties in Spain with a couple of buddies, close friends who I trusted. And the learning here was I didn't do my own due diligence. I kind of relied on someone else's DD, and that cost me, low six figures. In the end, we've managed to finally exit that portfolio, basically by kind of giving it away in the last year or so. But I learned a good six-figure lesson, I think, that's applicable across my, not just investing, my whole life. You can't buy conviction. You can't rely on someone else's diligence, even if you're, using a very expensive or high quality investment service. You have to really understand why it is you're investing in the thing you're investing in, because that's going to help you stay the course if the growing does get tough. If you're, let's say you're, invested in, well, Shopify, right? If you're invested in Shopify because someone told you to invest in it, or you're sitting on something like a 60%, 65% drawdown in the last couple of months, well, you're probably going to blame the guy or girl who gave you that advice and move on to the next thing. If you really, truly have conviction and understand the mission of the company and why this is just a natural part of the investment cycle, and you truly believe, as I do, genuinely, that the company has, an important set of capabilities that retail is going to need, and strong tailwinds and quality leadership, well, that's an opportunity to add to that position as opposed to panic and sell out. So yeah, that Spain DD failure has taught me quite a lot about the need to understand my own investments really elsewhere in my life.
So when you talk about how you can't buy conviction, I'm just thinking of it. Say we've got a listener that doesn't really know anything about investing. They're enticed by your lovely offer on Sovereign Investing. How would you recommend they use the service to get the most out of it? Because I'm presuming you wouldn't recommend someone actually just blindly buy all 7 stocks, or maybe, I don't know.
No, I wouldn't. Although I'm sure that's how some people use services like that. But I would treat it as a menu of things. So, rather than maybe your universe of companies being everything that's listed in the S&P and the FTSE, suddenly your universe is now restricted down to 100 and something companies that an expert team have done very high quality due diligence on. And you can read that and you can really bring your knowledge up the curve very quickly. So as probably your starting point is different because you're not looking at every company. You're now suddenly restricted down to what should be market beating range of investments. Certainly not everything is going to outperform the market, but on average, it's certainly our implicit belief that we're giving advice. We're recommending companies that will beat the market as a basket, right? And so, as an investor, sort of coming in or starting out, well, for one, I would want to build, enough of an asset base that I could have a diversified portfolio. And I suppose if you're investing outside an ISA, there might be a bit more flexibility. In an ISA, you can't really do fractional trading, I don't think, or certainly I haven't found a service that does that. And if you're investing overseas as well, the other thing you're hampered by if you're investing in an ISA, whenever you buy and sell, you're facing FX on both those transactions. You have to, you might own something that's listed in US dollars, but when you sell it, it turns back into sterling. So you're paying that FX charge plus the dealing fee, like the brokerage fee, that all adds up. So if you've got, maybe only say £1,000 in your portfolio to start out with, you probably don't have enough money there to overcome that heavy tax of all those different fees that you're going to pay. So you're probably better off starting in an index. But when you get to, I'm making these numbers up a little bit, when you get to say £10,000, then maybe then you can start to branch out and you can have a $1,000, £1,000 position. So at that point, you could have, let's say, 10 companies in your portfolio. So that's probably 10 companies, 10 to 15 is probably the sweet spot in terms of having sufficient diversification, but you can, you can still sort of focus your portfolio on areas where you feel you have an investing advantage. I think this is quite interesting, and I welcome your challenge on this. But I think, any of us can be an expert in the domains where we are, the topics that we're passionate about. Might be the area we work, might be hobbies. Maybe I'm not a fashion guy. You can probably tell by what I'm wearing today. But, maybe someone, is really into fashion and, in that world, they can apply their own domain knowledge and actually have an advantage over professional analysts, perhaps because they can see, the trends and next season and what's coming up. So maybe they can apply that knowledge. I don't think we have any fashion recommendations on the 7 Investing Scoreboard, but just giving a bit of a trite example, you can apply your own domain knowledge to this pre-existing subset of good quality investments, and I think you can find your own conviction that way. Does that make sense?
Yeah, no, I agree. Like, one thing I always think is, I think, like, if I'd been, so it's that sort of that Peter Lynch, isn't it? And like the Phil Fisher method of actually like looking at what's going on around you for your ideas as well. I know there's more to it than that, but I just think, like, I always think when I was a student, if I'd actually sat down and thought, based on my lifestyle and like what I'm actually using and like talking to my friends about, if I had to put my money in 3 things, what would they be? I honestly think the 3 things, if I'd had a little bit more awareness, it probably would have been Just Eat, which I think would have worked all right. It's not done fantastic in the last few years. Dominoes, which would have worked out incredibly well. And the other one would have been Bitcoin, because I had a few friends that knew about that back in like 2013 to 2014. And I was fairly receptive to it. I just never made that connection. I mean, I probably would have like then left it on an exchange that got hacked anyway. So, I think that was it might have been before Mt. Gox went down then, so I maybe would have lost it all in any case. But out of those 3, if I just bought those 3, which I'd say were probably the 3 things I was using quite heavily as a student, I'd have done unbelievably well.
Yeah, totally.
But we see it at work as well. Like, so for example, like we work quite closely with all the accounting software that everyone sees. And like I watched, was it the Fundsmith AGM a few weeks ago, the Terry Smith one, and he was talking about, I can't remember if they've just sold Sage or if it's in the sin bin, but either way, they're not very happy with Sage. And like if you'd spoken to anyone in our office for the last few years, they all would have said like 0. It's by far the best. It is so much better. And then like Sage just struggled to adapt really, and it's just that like, as someone who works in the industry, it's been very obvious for 5 or 6 years that Sage is just not as good as Zero. Zero is listed in Australia. I've never had a proper look at it, but I think Zeros will have definitely outperformed Sage if you look at the share price.
Right, exactly. And what you're exemplifying there is be the customer of the companies you invest in, because suddenly you really understand it from the inside. So, and if you can, you've sort of tied some of those investment decisions to your work. But it doesn't have to be your job. It could just be, your passion and your hobby.
I never bought Zero, unfortunately.
Right.
So how do you think about allocation and position sizing then? You've touched on it a bit earlier, but, like, for example, like how big would you let a position get and how much would you, I suppose it's a bit different now because you're not investing fresh money anymore, but how big would you make a new position?
Yeah, so I suppose sort of 2 ends of it. So if I'm opening a new position, generally buy about a 1% allocation in my own portfolio initially, just to get a feel for the company. I'll do that quite early actually, or not too much due diligence. It kind of motivates me to go a bit deeper. And then if I like what I'm seeing, and maybe I'll try and see another quarter of earnings, then I'll lift that up if it hasn't grown itself to a 2 or 3% position. And then this hasn't happened very often, but there's been a few over the years. Like notably Shopify and Netflix. if I really like the company and it's been a chunk of time and I think I really understand it well, then I'll lift that up to about a 6% position, or it will have grown there itself. And there's been a few exceptions, I generally won't add new money after it's 6%. But then, when you do get those crazy multi-baggers, they're obviously potentially going to grow that position to an outside level. So I start to get uncomfortable if anything gets to about 20% of my portfolio. It's definitely not a hard and fast rule. I think I would apply a lower number there if it felt like a much more volatile investment. So, for example, Netflix and Shopify, I was actually quite comfortable with all the way along the journey, and so I allowed those to get to 20%, and I would sort of trim them at various points to keep them around 20%. Tesla has been another big winner for me, but actually I've been uncomfortable with that for a couple of years now. I love Musk. I've got my SpaceX t-shirt on, and I don't know if you can see above me, I've got the Tesla tequila bottle right there, like recent birthday present from my brother. I love Musk, but he is erratic as hell, right? And so that volatility just is a bit too much for me to stomach. So I think my real test on this is, it's not literally keeping me awake at night. I sleep pretty soundly, but it's if it makes me feel a bit uncomfortable, that's probably the subjective trigger to trim it back a little bit. And if we stick on Tesla a little bit, I'll probably never not be a Tesla shareholder because it's just an incredible company. But I'm just a bit uncomfortable having a very large position exposure to it. So it's kind of one I'm keeping to about the 6% level. That's kind of where my stomach for volatility is for that particular one.
So how much time do you spend a month on investing in your portfolio? I mean, it's now basically your job, so I expect it to be fairly high.
It's like I say, it is my job, and it's a full-time job. But actually, even if I go back to telescope days before Seven Investing, like this has actually, honestly been my passion for quite a long time. At least 15 years, and that close collaboration with Albert. It's as much the thing we talk about exclusively. Some pretty boring nights out. If we go out with our other halves, we're just jabbering on about business models and companies. But it's been my passion, and so I would say there probably hasn't been a day in the last 15 years where I've not thought about investing. And often, and even before Seven Investing, most days, or many days, it's the only thing I think about. So also podcasts. I love podcasts because you can kind of consume them on the go, kind of multitask. I quite enjoy distance running. I quite enjoy the motorbike. I just did a month of skiing. Whenever I'm running on the bike or if I'm out on my own on skis, I've got podcasts blasting continuously, including your own. And, your brain's probably soaking up about half of the information that's being imparted. You zone in and out a little bit. But
your attention's a lot better than mine then, if you're taking in 50%.
Yeah. Well, and when you're hearing the same thing over and over again, though, I do often find myself going, hang on, what was that? That was really important. I need to rewind 2 minutes and just figure out what was just said. But, the power of the subconscious mind is pretty powerful. So, so I rarely listen to music. I'm mostly listening to, other guys and girls droning on about companies.
So, final question, it's not about your specific portfolios. What are your thoughts on Bitcoin as an investment?
Bitcoin, I'm not a huge fan of personally, although I think, I certainly wouldn't cast aspersions on anyone who has a Bitcoin investment. Crypto, I am a sort of quiet fan of, but a bit like Tesla, I think it's something that has a place in a balanced portfolio, but it's not something you want to be all in on. So I've probably got today, it fluctuates because this stuff's volatile as hell, maybe 1% to 2% of my portfolio in a mix of cryptocurrencies, mostly Ethereum. And I like all the smaller tokens I own, they all, a bit like Ethereum, they all do stuff. They have some utility, which is kind of why I'm not a fan of something like Bitcoin, albeit, incredible market penetration. And, it's really driven the industry to where it is today. But I think these sort of, things like Ethereum and ERC20, I'm more got exposure to them for the optionality. One of these technologies could become, a significant part of the way we all communicate, the internet of the future. And so I'm probably invested in crypto, I would say, more for that optionality, more so than to, make a buck as a sort of financial instrument.
We're at the end of the, I guess, more general questions. We'd normally move on to the portfolio questions, but we are now at like quite a sweet spot where people will get bored and stop listening if we carry on for much longer. So if you're all right, I'd probably be quite happy to park it, and then in a few weeks or whatever, if you want to come back on and just do another hour, that would be we can carry on.
No,
we might be the only ones at the end that are left. Seeing as we're at the end of part one, is there anything you'd like to say now, or where can people find you to learn more about you?
Well, I think first of all, big thank you to yourself and also to John, right? I've really enjoyed listening to your guys' podcast, and it's a delight to be a guest. We weren't planning to talk for nearly 2 hours here, and I've got through my coffee and my beer now. But so, yeah, delighted to break this into 2 halves, and I really look forward to coming back.
Have to bring a keg next time, won't you?
That's right, yeah, that's right. And part 2 I think could be interesting, because we were going to get into a number of actual companies I'm invested in and talk about those. So great to do another section on that. So maybe just to wrap it up, yeah, big thank you. I suppose I will give my own Twitter a plug. So you can find me on Twitter at 7 Luke Hallard. 7 LUKEHALLARD. And also I'm a lead advisor with 7 Investing now. And I did give the promotion a plug, but I'll just remind your listeners as well. So if you'd like to swing by, check out 7investing.com. If you use the promo code number 7 stocks, and you sign up in the next month or so, you'll get a half price rate on that first month. And I've got at least one investment there that I guarantee you won't have heard of. And I think it's a very exciting company. So I do recommend diving in. And if you don't want to pony up the $24, then we've got a 7 Investing Discord, which you can find a link to from our website. And we just registered our 1,000th member just yesterday. And there's, we haven't got the depth of the Motley Fool boards just yet, but we've got a ton of really good discussion happening, even behind our paywall, but also on our public boards. So swing by, have a chat to the advisors, myself and my colleagues, and other guests, and then maybe consider a membership after that.
Right. Well, thank you very much for coming on the show, and I'll speak to you in a few weeks probably when we've got a second interview sorted. And thank you everyone for listening.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.